Welcome to this video on Options for Beginners Part 1. We're going to break down options for you in a very simple manner. Options can be incredibly daunting, and it keeps a lot of traders away from trading them. However, options can be great for maximizing the growth of your account. We believe that by breaking down options into an easy-to-digest format will help you to understand how options actually work and how they might help you grow your account. So let's dive in bit by bit and get started. So what are options? Simply put, they are just contracts. So instead of buying shares, you're buying a contract. So one contract in an options position gives you control of 100 shares of the equity position. Now, this allows you to buy or sell the stock at a specific price. This is known as the strike price, and we'll get into that a little bit further. But just know that options are contracts. Contracts that allow you to be in control of 100 shares of the stock per contract. There are two types of options. There are calls and there are puts. As simple as that. Two types, calls and puts. Now, options have a uniqueness to them, meaning that they have some qualities that stocks really don't have. One of them is that they have an expiration date. So you could get into a position in a stock or an equity position, and you could hold that thing for the rest of your life. You could pass it down to your children and your grandchildren, and you could just have it forever. Options, on the other hand, have expiration dates. Whether it's weekly, monthly, quarterly, or daily, they have an expiration date, meaning that that contract will expire. So going into options, you have to understand that you cannot hold them forever. There is an expiration date. Now, the other thing about options is they have different strike prices, meaning in an equities world or a stock world, if a stock is trading at $100 and you want to buy or sell the position, you're most likely going to be selling it or buying it around the $100 if you want to get in or out of the position right now. However, with options, you can choose any strike price. So if the stock is sitting at $100, you could choose the strike price of $100. You could also choose the strike price of $105 or $110. Each strike price will have a different strategy to utilize around it, and a reason why you would choose a strike price that is not necessarily sitting at the same price the stock is sitting at. So know that there are options, pun intended, of different strike prices you can purchase or sell for the stock that you're trying to trade. And the other unique thing about options are the Greeks. Now, this is something that just totally boggles people's brains, and I don't want to confuse you too much right now. Just know that there are a certain set of calculations that go into option contracts, known as the Greeks, that change how quickly the option contract changes in price. So how quickly the premium and how much you paid for the contract goes up or goes down. We'll dive into the Greeks a little bit later. So how do they work? A lot of people like to use examples of buying a home, but I love food, so let's break this down in the form of pizza and make it really simple. So let's say tonight you want to order a pizza. And you call the pizza place, and right now the pizza costs $15, okay? But then you decide, I'm going to wait until my friends arrive later tonight and then we'll order pizza together. However, you realize that it's probably happy hour at the pizza place and the pizza price might go up by the time that you decide to get a pizza. So what can you do to lock in this $15 price on the pizza? What you can do is purchase an option contract. So you decide to give the pizza place $1 and buy one contract that states that if the price of this pizza goes up to $100 or higher, I can still purchase this pizza for $15 later this evening. So you lock this in and you're good to go. Now later, your friends show up and you call the pizza place. The pizza price is now $20. But you lucked out because you locked in the $15 price by buying one pizza contract for $1 and ensuring that that price would be yours later in the future. So now you get to buy the pizza for $15. Now, how do you make money off of this? In the options world, if you purchase the contract for $1 or the pizza for $15, and you decide to sell it back later on, you get the difference between the pizzas or the options contract. And that's how we make money off of it. So when you decide to get the pizza for $15, and let's say you change your mind and you don't want it anymore, if you go back to the pizza shop and there's a huge line out the door, everybody in line is waiting to pay $20 for their pizza, and you go to the person in the back of the line and you say, you don't have to wait in line until you get to the front of the pizza shop. I will just sell you my pizza right here and now for the same price that you would buy it for at the pizza shop when you get to the front of the line. So you sell your pizza for $20. Now you spent $15 to buy it, and you spent $1 for the contract. So that's $16 that you've spent on the pizza itself, and you sell it for $20, making a profit of $4 on your pizza. So the first type of option is a call option. If you buy a call option, you are technically long the stock. So you're anticipating that the stock will go up. If you sell a call option, you are technically short or neutral the stock. So you're anticipating that the stock will either go down or stay in a neutral position. Now, as a call option owner, you have the right, but not the obligation, to buy the stock at a specific strike price. So, meaning if you buy an options contract and your strike price is $100, so let's say the stock is at $100 and you purchase the strike price of $100. If that call option goes up, or if the stock goes up to say $150, when your call option expires, if you would like to exercise the right to buy the shares at $100, you can now be in control of 100 shares of the stock at $100, even though it's sitting at $150. This puts you up greatly on the position. The other type of options contract is a put contract. This is opposite the call. So if you buy a put, you are now technically short the stock. So you're anticipating that the stock will go down. If you sell a put, on the other hand, you're now long or neutral the stock. So you're anticipating that the stock will go up or stay in a neutral area, which we'll dive into a little bit more. But just know that put options, if you buy it, you're anticipating the stock will go down. And if you sell it, you're anticipating the stock will go up or nowhere at all. Now, similar to the call option contract, when it expires, a put option contract, let's say you get into a put position and you are buying a put at $100. If the stock goes down and now the stock is sitting at $90, when your put contract expires, if you decide to exercise that position, you could now own or be short 100 shares of the stock at $100, even though the stock is now sitting at 90. So when you buy back the shares at $90, you would actually be making a profit. So it's just flipped upside down to what the call position is. But as traders of options contracts, we're typically not looking to actually own the shares. So when you get into a contract position, whether it's a call or a put, you are usually exiting the contract itself before you end up with any type of shares in your account. So why trade options? Now that we understand a little bit more about how they work, let's break it down on why someone would decide they don't want to trade the equities position and they would rather use an options contract. So one of the main reasons is leverage and the less amount of capital that's required. Let's take a look at the difference in a equities position versus an options contract in Tesla. So let's say the stock price of Tesla is $100. If I buy 100 shares of Tesla, the capital required is $10,000. So I need $10,000 in my account to purchase at least 100 shares of Tesla. Now, on the other hand, if I decide I want to buy an options contract at the same price that Tesla is sitting at, so the stock price is at 100, the strike price that I want to purchase is also at 100, the premium to purchase this contract is $1 per contract. But remember, we have $1 per contract times 100 shares, right? Because each contract equals 100 shares. So I buy one contract and the capital required for this is $100. So I'm technically in a position where I have control of 100 shares, but I'm using way less capital. Notice how big of a difference this is between how much capital you need to get into the equity position versus how much capital you need to get into the options contract. It's a big difference. So another reason why traders decide to trade options rather than equities or stocks is because there's limited and defined risk when you're buying contracts. So not necessarily when you're selling, but when you're buying contracts, you have a very defined risk. Let's take a look at this Tesla equity position versus options contract position and see how that looks. So if you get into a Tesla position and you utilize $10,000 in the stock at the stock price of $100, and let's say that goes down $50. So tomorrow you wake up, Tesla has terrible news, and the stock itself is $50. you've just lost $5,000 worth of capital, right? So that it could go to zero and you could lose all 10,000 as well. And it doesn't have to happen overnight, it could just happen over time. Maybe you decide to bag hold and you decide to stay in a position you shouldn't be in, and you just end up losing all of your money. Now, in an options contract, when you get into a position and you buy a contract for $100, that price of the position you're in or that stock that you're in could go to zero overnight and you would still only lose $100. And if you're in a short position and suddenly the stock price goes to 1,000 or 2,000 or something insane, you still only lose $100. So you have a very defined amount of risk when entering into an options contract versus entering into an equities position. And another reason why traders like to get into trading options is because there's no PDT rule. This is for cash accounts only, so this does not pertain to margin accounts. But if you have a cash account, meaning you could have $1,000 in it, $5,000 in it, $100 in it, it does not need to meet the requirements of having $25,000 in an account. You can have something as little as 1,000, 100, it doesn't matter. And you do not have the PDT rule working against you. So a lot of traders end up going to either an offshore broker or trying to scrounge together all of their savings to make sure that they meet the requirements to have a $25,000 account to be able to day trade. But with options, with a cash account, you do not need to meet those requirements. So you can have a small account and actually continue to day trade. We covered a lot of the basics today, and we'll continue to do so until we get you to a point where you understand options in a more complete and cohesive manner. Stay tuned for the next video in this series and be sure to like and subscribe.